Hello and welcome. My name is Desi Arnaz, and over the next few minutes, I'd like to share with you some very exciting information. We are a real estate investment firm, and we specialize in buying properties at deep discounts all around the country directly from banks. Of course, as real estate investors, our goal is always to earn a nice profit for ourselves and for our partners. And what I've found over the years is that there are real estate investments opportunities all around us, but not all of them are profitable. The other problem that I've found for many investors is that they don't know how to recognize a good opportunity when it's right in front of them. And the third problem is that many people simply don't have the connections to get access to all of the best opportunities that are available in the marketplace. And that's where we come in. We have those connections. It's not really what you know. As the old adage says, it's who you know that really counts. Back in 1982, I purchased my first real estate investment property. I was told at that time by my mentor that in real estate investing, you make your profit when you buy. It didn't really sink into me until years later, but I totally get that now. You see, it's all about buying right. If you can buy a property right, the chances of you losing money on that property are almost zero. Now, while there are no absolute guarantees that you'll never lose money on any investment, real estate or otherwise, you can certainly reduce the odds of losing money by buying right. What I have also found is that the very best way to buy right when it comes to real estate is to find the most motivated sellers. And in this market, by far, the most motivated sellers are banks. You see, banks are loaded up with something that's known as shadow inventory. And they're being pressured to get rid of that inventory and get it off their books. Banks are not in the real estate business. Banks are in the money business. They're in the business of lending money, collecting interest and fees, and then sharing that profit with their shareholders. And when a bank finds itself with too many assets on its books, an asset being like a repossessed home or a repossessed car or anything like that, then they can get into trouble with the government, with the FDIC. Well, I can tell you that's like you and I being in trouble with the IRS. It's a big problem. And for banks, it's an even bigger problem because the way it works is that for every asset that the bank takes back in a repossession action, they've got to set aside a certain amount of money for reserves that they cannot lend. Now think about that. Think of it this way. If you owned, for example, a hardware store, and you were required by the government to set aside a certain amount of your inventory that you couldn't sell. Even if somebody wanted to buy it, you can't sell it because of a government regulation. You see, that's what happens to banks when they have assets on their books. The banks are told, before you can lend this money, you must first get some of these assets off your books. And if you just look at this slide right here, you can see, for example, that Union Bank, the last item on here, it's a San Francisco-based bank. They have $15 million of real estate on their books as of July 2013. And that's residential real estate, not even commercial. That's a problem for them. If they've got $15 million of real estate on their books, first of all, that's $15 million that they did not collect from the homeowners, right, because they had to repossess the properties. Secondly, it's a double whammy because now they've got to set aside about another $7 or $8 million in reserves that they can't touch until they get this $15 million off their books. And so they're motivated to make that happen. Now, that's just the beginning of the problem. There's a second wave of foreclosures coming. There's something in the banking industry called non-accrual assets. And a non-accrual asset is basically it's a debt that's owed to the bank, but people aren't making their payments on it. And you can see that right here with Union Bank, for example, at the bottom of the list, there's almost $317 million of non-accrual assets that are heading to the bank. Folks, these are future foreclosures that are coming down the pike. And think about that from a banker's perspective. They start to panic when they see that happening because they know they've got to set aside reserves to cover that and that's going to make their business less likely to be able to be profitable. Now, if they can't fix this problem, they've got a big problem. The FDIC will shut them down. Here's what's happened since 2007. Since 2007, the FDIC has shut down 488 banks. I mean, that's a lot of banks to be shut down. And primarily these banks were shut down because they had too many foreclosures on their books and not enough cash in their bank. It's a problem. And so in order to avoid going out of business, banks have to figure out a way to get this stuff off their books. And that's where we come in. When the financial meltdown first began back in late 2006, early 2007, the banks thought that, well, here's what we'll do. Since we're foreclosing on all these houses, what we'll do is we'll hire some real estate agents to sell these places for us, and that'll get them off our books. And that's a fine idea. As a matter of fact, you may have seen signs on real estate, you may have seen writers on real estate signs that say things like bank-owned real estate, right? You see realtors holding open houses trying to get these houses sold. But I tell you, the problem for the banks is that realtors, when they do find a buyer for the house, after months of marketing, sometimes that buyer isn't even qualified. Sometimes that buyer changes their mind. More times than not, the buyer expects to get a really good deal. Sometimes those houses get vandalized while they sit there empty. I mean, there's just a host of problems, and it's the slowness of it is the real problem, because foreclosures are coming in faster than the real estate agents can actually sell them off. And the banks are seeing that their non-accrual assets are becoming real estate owned very quickly, and they're getting in deeper and deeper hot water with the regulators. So the solution for the banks is to sell off these properties in bulk. You see, because if they can find one investor who could buy, let's say, 100 properties from them or 50 properties from them, they can get rid of those properties much, much faster. But here's the downside of it for the bank. Anybody that buys something in bulk expects something in return, and that something in return is called a big discount. And in fact, the banks are giving really big discounts to anyone that can come in and buy these properties off their books in bulk. You may have heard the term hedge funds. Well, a hedge fund is basically a group of people that have pooled their money together so they can go in and invest in something. In this case, we're going to talk about these people pooling their money so they can go in and invest in bulk purchases of real estate from banks. There's been a lot of hedge funds that have been doing that. There are literally billions of dollars that have been raised since 2007 to do exactly that. Now, these hedge funds, when they buy these things, they don't know exactly what they're getting, because they might buy 500 properties from a bank all at once, and they don't have time to go out and do what we call due diligence on 500 properties. When they make the deal with the bank basically gives them a week or two to kind of do a little bit of spot checking, and then the bank says, okay, close, or this deal's off. And so these hedge funds find themselves with a lot of real estate that they don't really know much about, and it's literally spread all over the country. What you're looking at here is a sample of a bank REO offering. For example, here, there's a property there on Citricado and Escondido. The market value of that property is $350,000, but the hedge fund may pick it up for about 500 properties. And we know that not all those properties fit the criteria of what you're looking for your fund. So if you guys have any properties that you don't want to keep on your books, we are a small fund and we're interested in buying maybe 4 or 5 properties from you. And then what happens is they send us what's called a mini offering, like the one that you see here on your screen, where there might only be 5 or 6 or 10 maybe properties that they're willing to sell. And we're able to pick those things up at a discount, just like the hedge fund did from the banks. So the hedge funds essentially serve as middlemen to help us pick up these properties from the banks because we don't have the deep enough pockets to go to the bank directly. But don't make a mistake about it. Just because we can't buy from Bank of America, Wells Fargo, or what I call the Big Five banks, doesn't mean we can't buy directly from a bank too. We do purchase assets from banks directly, but they're your community banks and your small credit unions. They have foreclosures, but they don't have 100 foreclosures. They have maybe 2 or 3, and they're willing to sell those at deep discounts to get them off their books. And we can do that. So we can buy from the banks or we can buy from the hedge funds. Either way. The other thing to keep in mind, too, is that many of these banks and hedge funds will not only sell the properties that they've already foreclosed upon, they will sell ones that are not yet in foreclosure, those non-accruals that I mentioned a few minutes ago. And if we buy the non-accruals, we literally become the bank for that homeowner, and then at that point we can work it out with the homeowner. We can do a loan modification if we want to. We can do a foreclosure. We can foreclose and lease it back to them with an option to buy it back in the future. I mean, we're the bank. And so we sit down with the homeowner and we make we work out something that makes sense for them and that makes sense for us. Now, when we buy these properties or these what we call assets, that would be the non-performing assets from the banks, we get them at pennies on the dollar, and we take care of it from there. Here's a sample offering of a non-performing asset. In that same example, let's look at this one again on Citrocado Avenue in Escondido. The unpaid balance on that property that the bank is owed is $420,874. The market value for that property is $350,000. That's what it's worth today. Well, our strike price on that might only be roughly $220,000. That's 63% of the market value. Once we own that particular asset, that note, then we contact the homeowner and we make arrangements either to get them reperforming, in other words, get them paying again, or to get them out of the house. And we decide that on a case-by-case basis. So that's how that works, and it's really a nice it's a nice position for us to be in because we become the bank for that homeowner. One of the rewarding things that I really like about what we do and the way that we invest is that we're actually able to make a difference. You see, many of the homeowners that we work with are struggling or have gone through hard times, but they're back on their feet. And so we can offer a loan modification. We can offer them an opportunity to start making payments again. We can forgive debt because remember, if they owe $400,000, but we picked up their note for $200,000, and the house is worth, let's just say, right in the middle, $300,000, we can reduce their balance down from $400,000 down to $300,000. They'll love us for that. We can reduce their monthly payments down to something that they can afford today, and we can then collect a cash flow every month until they pay us off. It could be 20 years, or they could refinance in 5 years and pay us off. But when they do pay us off, remember this: if we purchase their note for $200,000, and we reduce their balance down to $300,000, when they pay us off, they're going to pay us off $300,000. So we will make $100,000 profit at the time of payoff, and we make the monthly profit that they make each month. And get this, we get to do that on a loan modification situation without being their landlord. So if something breaks in the house, we're the bank. We're not the landlord, so they don't call us and say, hey, my furnace is out. They just keep making their mortgage payments. That's a beautiful thing. Another option that we can give to people is if they can't afford the house anymore, we can give them an opportunity to walk away and totally avoid foreclosure. Now, if they can avoid foreclosure, they can literally go and buy another house within 12 months. I mean, that's pretty sweet. We don't report any late payments on their credit. The only late payments on their credit would be the ones that were reported by the lender or bank that we bought the mortgage from. So it's a really nice opportunity for them. And in some instances, if people need a little money in order to walk away, we can give them something called cash for keys.